What's going on, YouTube? It's your boy Charles Enoch. You already know we back with another Invest in Myself episode. So run the intro. So today we'll be talking about how to pay off multiple credit cards using a small line of credit. But before we get started, you already know your boy got to do the YouTube thing. So make sure you hit that like and subscribe button for me and leave a comment down below. My goal is to reach 10,000 subscribers before the end of this year. I know it's a crazy goal, so I appreciate you guys for doing all three of these things for me. So I received a question the other day asking me, how can I pay off multiple credit cards when my line of credit cannot pay them all off at one time? What is the best method of getting my credit cards paid off with my current situation? And this is a really good question because based off the economy right now, banks aren't going to loan you a high line of credit. But we're going to use whatever the bank gives us and we're going to make it happen. So you already know. I got a whiteboard with an example and we're going to break this thing down. Let's go. All right, so on the whiteboard, let's take a look at the scenario here. So we have Bounce Back Brooklyn. Now, Bounce Back Brooklyn, her income is going to be $3,000 per month. Expenses are going to be $2,850, which means that her cash flow, the income minus expenses, are $150 per month. Now, Brooklyn is going to have 4 credit cards here. So credit card number 1 is going to be $500 with a minimum payment per month of $50. Credit card number 2 is going to be the same thing. Credit card number 3, $500 balance, but a minimum of $25 per month. And then credit card number 4, $1,000 with a minimum monthly payment of $25. Now, the line of credit Brooklyn has is $1,500, and the interest on that line of credit is going to be 10%. So the reason why Brooklyn is going to want to use the line of credit to pay off the credit cards is because if she puts her income onto all the credit cards to pay them off, she's unable to pay her rent through a credit card. So we're going to have another debt weapon in regards so we can use that velocity banking of putting our income into that line of credit and taking whatever we need out. So remember, income pays credit, credit pays expenses. So let's take a look at the other side of the board. All right, so we're on the other side of the board. So let's take a look at the equation here. So the first equation, we're going to use our line of credit to pay off 2 of our credit cards. So the 2 credit cards that we're going to pay first is credit card number 1 and credit card number 2. So each of them have a $500 debt on it with the minimum balance of $50 per month that you have to pay for each of them here. So once we use $1,000 of our line of credit, $500 each, that is going to free up our cash flow by $100 and decrease our expenses by $100. Because remember, the credit cards are $50 minimum payment each month there. Now, the next step of what we're going to do, we're going to take $1,000 of our income whenever we get it, right? Bi-weekly, weekly, whenever we get $1,000, we're going to put it onto the line of credit. What that is going to do is pay the line of credit back up to $1,500. Now, the next step is we're going to use $2,000 of our income, and then we're going to pay majority of our expenses. We would have $750 left of expenses. Now, how are we going to pay the rest of our expenses? We already know we're going to use the $1,500 of our line of credit. We're going to use half of that to pay our expenses, which leaves our line of credit at $750. Now, one thing that you may be thinking is, hey, we still have $500 on the line of credit. We could have paid off the other credit card as well. Now, the reason why I didn't do that and left $500 on there, just in case of emergency, right? Just in case I needed to pull cash out, I can just use the cash from my line of credit and pull it out. So I just decided to pay 2 cards instead of 3 cards. So let's take a look at the month of January, how we ended. We have a line of credit of $750 on it. We have a debt of $1,500. So pretty much we have credit card 3 and 4. Credit card number 3 has $500. Credit card number 4 has $1,000. So that's where that debt is. All right. So we're in the month of February here. So the first thing we're going to do, we're going to skip this first step because we want to pay a little bit more on our line of credit here. So we're going to go to the second step here. So what we want to do is pay our line of credit off. So we see in the month of January, at the end of January, we had a balance of $750 on the line of credit. We'll put $750 back onto that line of credit. We're going to pay that off in full. Now, the remainder of our income, we're going to pay majority of our expenses. So $2,250 put on $2,750, we'll have $500 left of expenses. Now, we already know how we're going to pay our expenses. We're going to use that line of credit, our $1,500 that we paid to full, right? And then we're going to use $500 of that, and it will leave us with $1,000 remaining on that line of credit. So at the end of February, we see we have a line of credit of $1,000, and our debt is still at $1,500 because we still have to pay off 2 more credit cards. All right, so we're in the month of March. Now, the first thing that we're going to do, we're actually going to pay another credit card off here. So we're going to use the first equation. We're going to use a line of credit to pay off credit card number 3, the $500 balance here. Now, when we use that line of credit, remember, we had $1,000 on that line of credit. So we're going to use $500 of it to pay that credit card off. When we do that, it increases our cash flow by $25 and it decreases our expenses by $25 because remember, the minimum payment was $25 and that was part of our expenses. That is eliminated now. So the next step is we're going to use our income. We're going to use $1,000 of our income to pay our line of credit back up to full, back up to that $1,500. And then we'll use the remainder of our income, $2,000, to put on majority of our expenses. Now that's going to leave $725 left on expenses. We already know how we're going to pay the remainder of our expenses. We're going to use our line of credit, and we're going to use about half of our line of credit to pay the remainder of our expenses. This leaves our line of credit at $775. So if we look at the month of March, we have $775 on our line of credit. Now our debt is only $1,000 in regards to our credit card. So we only have to pay off credit card number 4. All right, so we're in the month of April here. So we're going to go to the second equation because we're not ready to pay off our last credit card. So we're going to use our income, $725, because remember, we left our line of credit with $775. So we want to pay that back up to full, back up to the $1,500. So once we do that, our next step is our remainder income. We're going to use that to pay majority of our expenses. So we'll be left with $450 left of expenses. Now, the next step is we're going to use our line of credit, that $1,500 that we just paid up to full. We're going to use $450 of that to take care of our expenses, which leaves our line of credit balance at $1,050. So if we look at the month of April here, $1,050 on the line of credit, and our debt is $1,000, pretty much paying off that last credit card. All right, so we're in the month of May. So the first thing we're going to do, we're going to look at the month of April. We see that the line of credit is $1,050. So we want to pay that thing off in full here. So we're going to use $450 of our income, and then that's going to pay off the line of credit to back up to $1,500. Second thing is we're going to use the remainder of our income to pay off most of our expenses. We'll have $175 of expenses left. Guess what? We're using our line of credit to pay off those expenses. Now we see that we have we have $1,325 left onto our line of credit. So let's look at the month of May, $1,325 on the line of credit, and we still have to pay off our last credit card. So we have a debt of $1,000. All right, so we're in the month of June. So the first thing we're going to look at is the previous month and what our balance on the line of credit was so we can pay it off. So we had $1,325 left on our line of credit. So we're going to use $175 of our income and put it on the line of credit, pay it off in full. Then the next step is we're going to use our remainder income to pretty much pay all of our expenses. We'll be even left with $100 to spare of cash flow, right? So this last step, we don't even have to use it because we were able to pay all of our expenses off with our income here. So we're looking at the month of June, line of credit paid up to full. We have $100 of spare money, let's say in our savings, our checking account, right? And then we have our credit card of $1,000 balance left. All right, so we're in the month of July. We're ready to pay off that last credit card here. So the first thing we're going to do, we're going to use our line of credit to pay $1,000 off on that credit card here. And since that last credit card, the minimum payment is $25 per month, that's going to increase our cash flow and decrease our expenses because it's not part of our expenses anymore since it's paid off in full. So the next step is we're going to use $1,000 of our income to pretty much pay our line of credit back up to full, back up to the $1,500. Now next, we're going to use the remainder of our income, $2,000, to pay majority of our expenses. We'll have $700 remaining in expenses. Now we're going to use our line of credit to pay the remainder of our expenses of that $700. This leaves our line of credit at $800. Now, so if we look at the month of July, we have $800. That spare $100 is still there. I know you guys are kind of questioning why didn't we use it. I will let you guys know once we finish this scenario why I did not use it here. But we see that the debt is paid off for our credit cards. So that is great. All right, so we're in the month of August. So the first thing we're going to do is we're going to use $700 of our income to pay our line of credit back up to full. Remember, in July, we had $800. So we're just trying to pay that off in full here. So the next step is we'll use the remainder of our income, $2,300, pay majority of our expenses. We'll have $400 left. We already know we're going to use our line of credit to pay the remainder of our expenses, which leaves our line of credit at $1,100. So let's take a look at the end of August here. We have $1,100 on our line of credit, and then our debt is zero since we paid off our credit card. All right, so we're in the month of September here. So the first thing we already know, we're going to look at the month of August. We see $1,100 on our line of credit. We want to pay that off in full, so we'll use $400 of our income and pay the line of credit off in full back up to that $1,500. Now the next step is we'll use the remainder income, $2,600, pay off majority of our expenses. We'll have $100 left over in expenses. We'll use that line of credit, the $1,500, to pay that $100 off. We see that we have $1,400 left on our line of credit. So if we look at the month of September, $1,400 left on the line of credit. We see the spare money. If you put the spare money on the line of credit, that would be $1,500. And then the debt, we paid all our credit cards off. Now, with this scenario, the reason why I didn't really apply that $100 is because with the line of credit, it is calculated by simple interest. So depending on how your check drops or whatnot, you're getting charged interest daily. It's not a lot, but you are getting charged interest daily. And the other thing is too, when you're paying that minimum payment on your credit card, you're getting paid or you're getting charged interest as well. So that $100 really probably wouldn't even be there because the interest will be eating that up. So that's why I didn't really apply that spare $100 to the equation. Realistically, you would have to do another month for like October to get this paid off. But obviously I didn't have enough space on the board. But I think that everybody gets the concept in regards to what we're doing in regards to pretty much just consolidating the credit cards onto the line of credit, because sometimes we can't do that velocity banking with putting your income into the credit card and just using your credit card to pay the expenses, because there are some expenses like a mortgage that sometimes people cannot use a credit card on. So the line of credit would be the best option. So we're still doing that velocity banking. It's just with a different debt weapon. So hopefully that made sense. Please like, share, subscribe, leave a comment as well too. Like always, you guys have a good weekend. Peace out.